Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today we're focusing on trading vertical spreads. We want to talk about how to trade a vertical spread, but also have a plan in place to get out at a target price to manage potential profits, or to have a stop in place to manage potential losses. Both of those can be important elements of a complete system for trading spreads, so I think this is going to be a great discussion. I also want to frame this all within the current context of the markets. Yes, the markets just hit an all-time high again today, but there's some other potentially very important market context that we need to see regarding what's happened historically at this time of year. So interesting discussion ahead. Before we can get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Great to see all the familiar names. Great to see anybody who's here for the first time. But hello there, Dragon Rider, JDLMI, Edible, Josh, Jay Richardson, Chris, Simone, Scott, Life in the Fast Lane, Richard, and Eric, and everybody else. Thanks for joining us week after week. We always appreciate your attendance and your contributions to these discussions. If you're among those who are here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy the recording. It's a great way to watch these webcasts, but you're certainly invited to join us in the live stream. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern time. Now, I also want to let you know that my very good friend, Mike Fairborn's hanging out in the chats on YouTube. He's going to be keeping an eye on any questions that come in. If I can't get to those, Mike's going to be picking up my slack for me. Mike and I have now been working together for the better part of 2 decades. So Mike brings a ton of experience to this. Thanks for having my back there, Mike. Mike and I would also like to issue an invitation to everybody watching to follow your favorite Schwab presenters on social media. So you can find me and Mike on X. You can find Mike there at Mike Fairborn CS. You can find me on X at Cameron May CS. You can give us a follow there. Both very active there. You can also now follow me on LinkedIn. You just go to linkedin.com/in and then /Cameron May CS will take you to my profile where you can give me a follow. But let's get into this discussion. Noodlebrand says, I'm terrible at managing losses and never know when to exit, just end up watching it drop forever. Well, maybe this is a good discussion to be having today then. In any case, as we do this, we need to bear in mind this important risk information. Equity and index options carry a high level of risk and are not suitable for all investors. Schwab does not recommend the use of technical analysis as a sole means of investment research. This material is intended for general informational and educational purposes only, and investing involves risks, including the loss of principal. All right, so here's what we're going to be talking about today. So first thing that we're going to do, I do want to have a look at what's going on with the S&P 500. We'll let that be the stand-in for how stocks are doing generally. But the S&P did touch all-time highs just today. So we might be thinking, well, can it keep going up from here? Well, let's see what's going on historically. What has the S&P done at this time of year? Then we're going to plan and place a new options trade for, let's do it for the February expiration. We're here toward the end of January. Let's go out to that third Friday, February expiration. So we're going to do a vertical spread. Today's example trade is going to be a bull put spread, but we are going to look at this through the lens of the trader who wants to know when to get in, but also maybe wants to have a plan for when to get out with profits or with losses. So we're going to plan both sides of that trade, and we're going to place orders, hopefully in that effort to manage either profits if they emerge or losses if that's what occurs. All right, so it should be a really good discussion. Let's go right to the Thinkorswim desktop trading software platform. This is paper money. And let's have a look at what's going on with the S&P 500. And as I mentioned, we just touched all-time highs today. Notice we're at 69.83. The highest we've ever been before at the highest point was 69.85. And today's intraday high, we've stretched all the way up to 69.58, almost 69.59. So that is uncharted territory. We've never been there before. So let's plan for our example trade today. Let's look out here to this February 20th expiration. That's going to be when that'll be the trading time frame for today's example trade. And let's do that on this assumption. Let's just say that our trader here has the bold assumption that maybe stocks are likely to go higher than they are right now. Well, I say sort of tongue-in-cheek, that's bold, because that's what it's been doing most of the time for the last 10 months. Certainly not a guarantee that that's where we're headed as we move toward February 20th. But I think that there are plenty, though, that when we are at all-time highs, there could be that concern, can stocks continue to move higher? Well, maybe they won't. We don't know. But let's look at what stocks have done at this time of year historically over the last 20 years. We're going to be looking at a seasonality chart. Now, before we go look, let me ask you, if we're looking out to placing a trade through February 20th, what do you think stocks have done historically between, let's be specific here, between January 27th, today, and the 20th of February? Might be an important question if that's the time frame of this example trade. So let's go have a look at what stocks have done historically over the last 20 years. And to do that, we're going to use a type of chart. It's known as a seasonality chart. So we're going to go to Style up here at the top. We're going to change this from a standard candlestick chart to a seasonality chart. So when you first load this, we're left with two lines. This first line is just showing us year to date how the S&P has done. So we're up a little bit so far for the year. In other words, going from January 1st to January 27th, this is what we've done. This is what the S&P did last year. Okay, well, we already know that. We were looking at that 1 year chart, but I want to look at longer than that. Let's look to see what we've done over the last 20 years on average. And to do that, we just need to do a couple of things. First of all, we're going to change our time frame to a 20-year chart. And this is now a 20-year sort of average chart for the last 20 years. And I want to zoom in on that. So the second step is to come up here, change this to manual, which enables a zoom feature where we can click and drag from above that 20-year chart to below, and it's going to zoom in on that chart and make it full screen size. There we go. Now we're no longer looking at what's been happening, just over a year to date, but we're exclusively looking at an average performance chart of the S&P 500 over the last 20 years. And what I wanted to look at today, if this is average, well, let's look at the average January 27th, which is here. I don't want to draw a horizontal line. Let me switch up my tool here. Let's switch our current tool to a trend line tool. So from January 27th to February 20th, where's the 20th? 20th, right there. Is that it? Yep. We've seen a fairly pronounced bullish tendency in the S&P 500. It's not guaranteed that's what 2026 is going to bring, but that might lend a little bit of additional, confidence to our trader. Obviously, nothing's a guarantee, but there's our historical context. Maybe in this case, the trader might be looking for, well, if the bulk of that growth happens, by the 17th of February, maybe we ought to have a plan to take what profits arise if they do before we push all the way to expiration. Well, that's a good idea, maybe. How might we put that into practice? Well, let's go to an individual stock chart. Now, first thing I'm going to do is switch this back to a 1 year chart. Then we're going to switch our chart style back to a standard chart. There we are, back to familiar territory. And I want to bring up an example stock. This is going to be our example trade today. We're going to be trading Broadcom. There are a few things that are interesting about Broadcom. So today is Tuesday. As of yesterday, on Monday, there was a new type of option that was introduced on Broadcom and on the Mag 7 stocks, along with IBIT. And that is, there are now Monday and Wednesday short-term or weekly contracts where they expire on Monday and Wednesday rather than just on Friday. So that's an interesting little tidbit that I wanted to throw out there. We're actually not going to be trading the Monday or the Wednesday for this discussion. We're going to go all the way out to February 20th, just like I originally planned. But I didn't want to point that out as something new that's been happening, brand new type of options contract that was just introduced yesterday. Another thing, though, for our would-be trader here, is just what's happening on the chart. So how did I select Broadcom, other than a little interesting sort of trivia that I just mentioned? Well, for an options trader, in order to, in their priorities for selecting a stock for potentially trading options, could be a number of things. It might be that they're impressed by the performance of the sector that the stock is in, and maybe their perceived view of the sector's near-term future. They might also be looking at the fundamentals of the company. Maybe they think that this is a particularly strong stock from its earnings and historical earnings and future earnings growth perspective. That's another potential view. But there do tend to be some common themes running through the priorities of a lot of options traders. And one of those is price per share. Obviously, higher priced stocks can have higher priced options, but they may also just offer more options to choose from. Another thing is liquidity. If a stock is illiquid, its options tend to be very illiquid, and it can make it harder to get into or out of those contracts. And finally, what's happening on the chart? For those that use charts, maybe they're looking for, if they're planning to do a bullish trade, maybe they want to see some indication of bullishness on the chart. So let's see if that's what we see on the chart of Broadcom right now. And as we turn our attention to this chart, maybe our technical trader has observed that there was a short-term price ceiling right here at about that 320 level where the stock hesitated for about 6 weeks after a nice run up. And then finally an earnings announcement gave it a nice push through that ceiling at the 320, at that 320 level. And since then, that seems to be a pretty good price floor. Over the last, how long has this been now? 1, 2, 3, 4, 5 months, where Broadcom just seems very reluctant to close below 320. Well, that seems to be, maybe our technician notes that that looks like a pretty solid price floor. And maybe in the short term, they think that we're likely to rise up to, I don't know, maybe 355 before we run into a price ceiling. So maybe their outlook here, as they're looking forward to February, is, well, at the very least, possibly they have the expectation that the stock will stay above 320, maybe rising to 355, but it's done a pretty good job over the last 5 months of just at least staying above 320. So let's structure a trade that can benefit, theoretically, if it just does that. Doesn't even have to be bullish, but just staying above that support level. That's how we're going to structure this trade. Okay, so we're talking about vertical spreads today. And there are a couple of different basic types of bullish vertical spreads. We could do a long call spread, or we could do a short put spread. And I thought, I want to do a short put spread today, because for trading, for planning the back end of the trade, targets and stops, it's a little bit more complicated. It might require, for those that are new to this sort of trading, a little bit more hand-holding, because everybody is somewhere along their own personal learning curve. And this is just one that's, I think it's a little bit, it requires a little bit more of a stretch of the logic in order to plan for targets and stops, managing profits and losses. With a long call vertical spread, I can just sort of summarize it this way. If whatever we pay for it, we try to sell it at a higher price, and we'll put our stop down at lower prices. That's kind of like trading a stock. It's not a huge logical gap. But for credit spreads, it's the opposite. It's a little bit more difficult. So let's do that. Let's do a bull put spread. Selling a put is a bullish strategy, and then we're going to turn that into a spread to try to manage the loss or risk exposure. So here's going to be our example trade today, with the stock sitting above and rising above 320, hanging above that 320. How about if we look at, I don't know how much we can get for it, but let's look at maybe selling a 320 put. Let's go to our trade tab. Let's go to the 20th of February. And as we look at this, notice how many weekly expirations there are now. That's because some of these are those new Monday and Wednesday expirations. For example, that 2nd February is next Monday. But let's move on out here to the 20th of February. And let's look over in the put column. And it looks like we might be able to sell, let's say, a 320 put for around 965 or 980. So let's call it about 970. So this is going to be our example trade. This is known as a short put spread, also known as a bull put vertical. But it begins, hypothetically, with the sale of a put. In reality, we very commonly just sell a put and buy a put at the same moment, although it is possible to leg into a put spread. But let's sell the 20th of February, that 320 put for, and I said 970. It looks like it's holding in there at about that price. Now, if we just did that, that actually is a bullish trade, but it has significant downside risk exposure, because what the trader would be doing here is accepting, theoretically in this case, $970 as a credit, collecting a premium, but someone basically is paying them $970. But what are they getting out of the deal? Well, for the next 24 days or through the 20th of February, someone else would have the right to sell this trader the stock, or shares of Broadcom for $320 per share. That's the deal. Accept the payment of $970, but in exchange, we have a contractual obligation to, on demand, entirely at someone else's discretion, we have to buy shares of stock at $320 no matter what they're worth. If they're only worth $300, if they're worth $280, doesn't matter. We have to buy those shares for $320. Well, that would be a naked short put. Let's cover that thing. We're going to, at the same time, buy another 20th of February put, but a less expensive one. How about for today? Let's go to the 310 as our example. We're going to buy the 310 put, and that looks like that's trading between 655 and 670. Let's call it 660, just so we're using round numbers. So what does this contract allow the trader to do? Well, they have one contract that requires that they might have to buy some shares for 320. This one allows them to sell shares at 310. So the downside exposure in this trade is now limited to $10 theoretically. So that's a significant reduction in the downside risk exposure that cost us $6.60 to set that up, or to impose that limit. So what does that leave us with how much we can make or how much the trader can lose on this trade? Well, the maximum, or the net credit here, which is also the theoretical maximum gain of this trade, is, if we collect set 970, but we spend 660, that would leave us with $3.10 of risk. Now, Dave says, what's the open interest on these trades? So Dave's interested in another sign of liquidity. So one thing that might be a sign of whether a contract is relatively liquid or not is just the distance between the bid price and the ask price. If there is a wide spread between those two prices or values, that could be an indication that there's a lack of liquidity or poor liquidity on a contract. So like if our ask price is at $10 and our bid price is, let's kind of exaggerate it a little bit, but this isn't entirely unheard of. Ask is $10, bid price is $5. Huge spread between the bid and the ask price. It probably means there's not a lot of liquidity. On the other hand, if it's a relatively narrow spread, in this case, it's 20 cents on a $9.80 contract, about 2%. That's a relatively narrow spread. But another potential indication of liquidity is, let's add it here, Dave. How about, let's do this. Let's borrow our Vega column for just a moment. I'm going to click on this, and I'm going to go to, or should we add that? No, it's going to get crowded. Let's go to option theoreticals and Greeks. And, oh, pardon me, we just wanted a basic. We want the open interest. Is that what you wanted there, Dave? Yeah, there we are. So open interest basically is just telling us how many open or active contracts there are at different strike prices. So at the 320, there's 7,400 or so. At the 310, there's about 16,000, right? There we go. Maga says, can we also get volume? Yes, we could. I'm not going to, because it's going to start cluttering up. It's going to make our columns kind of compressed. Now, if we wanted more space, what we can actually do is change this from showing both calls and puts to just showing puts. That gives us more space here. I'm not going to do that for this discussion. but I want to point that out. But volume could be another indication. Now, here's the deal, though. Checking different indications of liquidity can be important. It can also stretch out to being possibly redundant. I just want to throw that out as a possibility because we are talking about Broadcom, which happens to be one of the biggest companies in the world. And if a trader's requirements for liquidity are above being one of the biggest companies in the world, we pretty much start to run into a ceiling of no trade candidates, right? But good questions. Anyway, so we have our $3.10 that might be made on this trade. How much can we lose? Well, you might have deduced from earlier, well, if we're required to buy the shares at 320 and we can sell those at 310, that's a $10 loss. So can we lose $10 on this trade? No, actually the maximum is less than that. The theoretical maximum, the theoretical max loss is $10, but we did get the $3.10 as a credit to get into this deal originally. So that gives our maximum theoretical loss actually just under $7, so $6.90. There we go. So these are sort of the mathematical realities of the trade. It is a high probability trade with a low reward to risk ratio. That's the way it works. When trading vertical spreads, when a trader is going for a high probability of success, typically the reward for being successful is going to be comparatively low. There we go. So that's our trade realities. Well, one or the other could happen. So maybe we ought to have a plan for both. So let's talk about how these outcomes may occur and how the trader might plan and place orders to try to optimize reward potential and hopefully minimize risk potential. So Judith says, why not do 320 and 315? Judith, the short answer to that is because I typically do $5 wide spreads and I wanted to do a $10 wide spread. But that's not the real consideration for a trader. When selling a credit spread, if we do narrower spreads, that limits the risk actually. Instead of having $10 of risk, we'd have $5 of risk minus our credit. So it's significantly smaller risk, but also that comes with a smaller reward potential. We have to spend more of the credit that was received. So if we're getting, $9.70, instead of spending $6.60 to minimize risk, we might be spending somewhere around $8, not leaving as much credit. One other very significant consideration is that the stock doesn't have to move quite as far in order to expose the trader to that maximum risk. With the trade as I've currently constructed it, our maximum loss might be realized at expiration if we're below 310. If we did the 315, that maximum loss might be realized at expiration if we're only below 315. So there's not as much wiggle room to the downside. So there are pros and cons. Smaller risk exposure, but less credit, and a little bit higher exposure to a maximum loss scenario. So Paul says narrower strikes give better reward to risk. Right? Yep. But a greater exposure to risk because the stock doesn't have to fall as far in the case of this bull put spread. So good question. Obviously, I'd like to dedicate more time to clearer answer there. So I'll just tell you, I answered that fairly quickly. I recognize that. To me, that's an inadequate answer. I'd rather go just explain it all and run the math and do a side-by-side comparison. It just takes too much time. So you might need to go back to the archive for this webcast and listen to that again. Slow it down, sort of process why I said what I said. That might help, okay? But let's go talk about how reward might be achieved, how risk might appear, and how we might have a plan for both of those. So here's how we've currently constructed this trade. Let me clean off my chart here because I want to give emphasis to just these two levels. So first of all, we have 320, which is right down here. We decided to do that 320 level right about there. That's close enough. I drew that line kind of terribly. And then 310 is right here. Ooh, can I nail the 310? I think I did. All right, I'm going to be nitpicky. Let's right click on this and edit the properties and make that exactly 320 because I just want to. All right, so those are our two strike prices. So our trader here is hoping for the stock, which is already above 320, to stay up there and maybe just go higher. But really, anywhere in this green box is where we'd like to be, above 320. Where we would not want to be is down here, anywhere. This is our max loss territory. So let's make that red. There we go. So this is sort of our no-fly zone, and let's talk through what happens. So if we go up, or we go sideways, or we go down, but we're still above 320, what happens in these scenarios? Well, the stock is worth more than $320. So if someone has the right, someone out there has a contract with this trader that says, hey, I can sell shares of stock to you at any time, up to and including expiration, for $320. If the shares are worth more than $320, though, they're just not likely to do that. They can get a wild hair and do it anyway, and require that the trader buy the stock for a lower price than it's worth. Yeah. No, in most cases, they're just going to allow that contract to expire worthless, and our trader then has a realized gain of $9.70. Congratulations, that worked out. But at the same time, our trader has the right to sell shares at 310, but their shares are worth way more than that, or significantly more than that. Let's say from significantly to way more. So our trader decides, well, I'm not going to sell shares for 310 either, and their investment of 660 is then lost. So we have a realized gain of 970, a realized loss of 660 at expiration, and there's our maximum gain, $3.10. What else could happen? That's fun to talk about a trade working out. Well, maybe our trade doesn't work out. What if our stock goes down? So I'll just leave those lines on there. But let's say we pop down here below 310. Well, someone has the right to sell shares to us for 310. They're worth 300, less than 310. Somebody has the right to sell for 320. They're worth less than 310. Are they going to do it, especially at expiration? Yes, with very few exceptions. They say, hey, Cameron, here are my shares for 320. Can't get 320 for them anywhere else. So they sell those shares to us, and we think, well, we don't want those shares. They're way overpriced. So here we might choose, if the stock is, let's say, worth $300, and we have a contract that says we can sell it to someone else for 310, we do that. So buy the shares at 320, sell at 310. Ouch. Can we say ouch? That's a $10 loss, for which the $3.10 that we collected up front is small compensation, but it leaves us with a $6.90 loss. So those are sort of the best case and the worst case outcomes. There's a different case. Here's one other thing that can happen, and we need to be aware of this. Let's activate this drawing here, and let's say, what if we go down, but just not below 310? Maybe we're in between at 315. Well, at 315, the trader who has the right to sell to us for 320 probably going to do it. They sell us those shares for 320. We don't want to sell for 310. So in that case, maybe we just wind up keeping the shares at 315. And from there, it's up to whatever the shares do. If the shares can recover and go up, great. If the shares continue to fall, not so good. So Kupali says, can you show the same for calls? Can't do it today. My apologies. I don't have that much time, but I have in the past. So let me show you a resource. If you want to understand lots of these sort of what I call building block strategies, I put together a series of 10 lessons for new traders of options that have been, they're videos that have been recorded and posted on our archive. So here's what I would suggest. If you haven't done it already, make sure that you're subscribed to our Trader Talks channel. So you can go down below the stream right now or below the video, just click on subscribe. It only takes a second. It doesn't cost anything to do that. But that's where, but our Trader Talks channel is specifically called Trader Talks Schwab Coaching Webcasts. This is where you can join our live streams on YouTube. You can also find playlists of previously delivered webcasts, including these 10 lessons that I'm referring to. So let me go to the playlists. And if I scroll all the way down through all of our different webcast series, my playlist is pretty much right down at the bottom. So there's Getting Started with Options. There's me in the same shirt. That was just for convenience. Obviously, I wanted you to be able to find me as easily as possible. Anyway, let's click on View Full Playlist. And then I'm just going to scroll down through here until the words lesson or the word lesson pops out at me. So it takes a second to scroll down far enough. But there we are. Look at lesson 9 here. Short put spreads. That's what we're talking about today. Look at lesson 8. Short call spreads. So if you want to learn about call spreads and their reward and risk and what might happen at expiration, watch that video. But what I might suggest, if you're not terribly familiar with options, start at lesson 1 and work your way through that series. Okay. Somebody says on 0 days to expiration short vertical, do you get the maximum loss if the price of the options go to 0? Yep, that's it. Well, not the maximum loss. I'm sorry. We're talking about credit spreads here. That would be maximum gain. If the value of the contracts go to 0, that's actually what we're looking for on a credit spread. Anyway, so hey, you're welcome, Kapali. Absolutely. But maybe what we ought to do is have a plan for outcome number 1 or outcome number 2 and try to sidestep outcome number 3 if possible. That is if the trader really doesn't want to wind up owning the shares. So let's build a plan and put that plan into action through orders. So let's talk about the fun part first. Managing profits if they arise. Now this is a strategy. We can see right here, there's about 3 times as much that can be lost as there can be gained. So how about our trader wants to grab as much of that reward potential if the opportunity arises without limiting that upside potential too much. So here's going to be our plan. This is just an example. Not everybody does it this way. But let's say that our trader would like to get out. If they can do it tomorrow, great. Probably not going to be tomorrow. But at any time between now and expiration, if we can get out with at least 80% of the $3.10 that could be made, we're going to do it. Right? On the other hand, we also might want to mitigate that risk to whatever extent possible, or at least to some extent. So instead of just saying, well, let's just put on the trade and see how it works out. Maybe we make 310, maybe we lose 690. Well, if the stock starts to misbehave, let's say the trader just draws a line in the sand. Now, options tend to be fairly volatile. So we're going to give this some wiggle room, but let's say instead of allowing the contracts to go all the way to maximum loss, maybe we stop the bleeding at 50% of maximum loss, or as close to that as we can. So that's going to be the plan. Maximize the reward potential, minimize the risk potential. What does that actually work out to be with a credit spread? How do we do that? That's actually an important question, and it's not always intuitive. So I want to talk through that. So yeah, Megan says, how do we get out at 80%? Well, here's what we do. What is 80% of 310? Well, I can come up here to my calculator. 310 times 80 is 248. In other words, we want to get out when we have an unrealized gain of at least $2.48. But this is where doing that with something that we bought and something we sold is very different. So we collected a 310 premium, and we want to keep $2.48 of that in our pocket. So how much does that leave that we can spend to get back out of this trade? Well, my quick math says 62 cents. If we spent 62 cents to close the trade, that would leave $2.48. I'm using this term, but in the pocket of the trader. That would become a realized gain. Does that make sense? Or another quick way to do that is if the original credit collected is 310 and we want to keep 80% of it, then we multiply 310 by 20%. That tells us we can spend up to 62 cents to close this out. So keep this in mind. Let's maybe expand that a little bit more. Close at 62 cents. Okay, so that's going to be our plan for managing the profits, if we can do that. But it's also possible our stock turns and goes down, it's moving in the wrong direction, and we're taking lumps. In that case, what's actually happening is if we got into the trade right now, theoretically, we might be able to get right back out of that trade. It would cost us $6. Well, not exactly. No. Boy, I'm going to have to back away from that. Nope. Don't listen to what I was about to say. Anyway, if we got into it right now for 310 and we tried to buy back out, it might cost us about 310. Worst case scenario is it could get more and more expensive to buy back out, up to $10. Yep, that's the worst case scenario. If we have to spend $10 to get out of a trade that we only got $3.10 to get into it, how much would that be as a loss? $6.90. Yep. So if we don't want $6.90 of loss, here's what we might do. What is half of $6.90? Well, you can probably do the math on that. It is, oops, let's just divide that by 2. There we go, $3.45. So if we only want to expose ourselves to $3.45 of loss, here's the math. In for 310, $3.45 plus 310 means maybe we pull the plug if this thing is $6.55 or more to get out of. In other words, our credit spread right now is trading at 310. We're hoping it goes down in value so we can get out at 62 cents. If it's going the other direction and it's becoming more and more expensive, at $6.55, if we decide to get out then, if we stop the bleeding, we pull the plug, we pay the $6.55, that would be a $3.45 loss, or half of the $6.90 that we could have risked. So that's going to be our trade. So a stop at $6.55. And actually, to be a little bit more accurate, a little bit more consistent with my terminology, let's call this our target. Target at 62 cents, stop at $6.55. So that's the math. And fortunately, this webcast is being recorded. So if it's your first exposure to the math of exiting a vertical spread, you may want to go back to this portion of the archive and rewatch that. So Kelly says again, how did you get to $6.55? So half of $6.90 is $3.45. $6.90 is the most we can lose. We're trying to lose half of that. $3.45. So if we're spending $3.45 more than the $3.10 that we received to get into this trade, that would be that $3.45 loss. So in other words, half of the $6.90 that we could lose. So don't be, if you're still struggling to wrap your mind around that, believe you me, the best of us struggled with it the first time we were introduced to it. That's why I wanted to talk about credit spreads. Debit spreads are just way easier. I think traders are used to, well, if I paid $5 for something and I can sell it for $7.50, that's a $2.50 profit. If I paid $5 for something and I can only sell it for $2.50, that's a $2.50 loss. That's easy math. But when we enter a position by selling, receiving a credit, the math is all backwards. That's unnatural. It's hard to process the first time. So I understand. Okay. So El Camino says, can you close a spread as a net credit with a bracket order? There we go. Good thinking. Let's go do it. Let's put this plan into practice. All right. So this is going to be our trade. And it may be different right now. Let's see what our credit is likely to be. We may need to make it a quick adjustment here. And it's going to give us a chance for some repetition. So I'm going to come up here to where it says spread single. And I'm going to change this to a deep and wide vertical. 1 month, Both of our contracts are in the same month, but our strikes are 2 strikes apart. 310, skip 315, 320. So let's go for a 1 month, 2 strike vertical. There's our 310 and our 320. And yeah, it looks like we might only be able to get about 290 for this right now. Let's click on the bid price and create an order. And let's say we're able to get a 290 credit. All right, let's lock that in at 290, set that as our minimum. We got to rework the math. 290 credit, how much does that leave for risk? 710. If 290 is the most we can make, what's 20% of 290? 290 times 0.2 is 58 cents is our new target price. If 710 is the maximum we want to lose, half of that is 355. That's 710 is the theoretical maximum that we could lose. Half of that is 355 plus the 290. Oh, I got to do that one more time. 355 plus 290 means 645 is going to be where we put our stop on this new, slightly different spread. All right, so let's do that. How do we put that into practice? Let's, first of all, instead of just putting in a single order, how about for today's example, let's just do one contract. Whoops, there we go. I'm going to change this to a first triggers OCO order, meaning if the first order, if our entry order to get into the vertical spread is filled, we're going to put in 2 exit orders to get us back out. So to create our 2 exit orders, I'm going to right click and create an opposite order for our target. I'm going to right click and create an opposite order for our stop. All right, so 290 credit. All right, where was our stop? Actually, let's do the target first, since that's the way we laid it out. So our target was going to be 58 cents. That means, hey, I want to spend 58 cents. That's my limit. Don't want to pay a penny more to get back out of this trade. Let's make that good till cancel. And then our stop was going to be, what was the new one? 710? Oh, no, it was 645. There we go. So our stop's going to be at 645. Make that our stop. Make that good till canceled. And that is how we put into practice a target and stop managing profits or losses on this trade. So I think you can envision now, if we receive a credit and we can close that out, if we can buy out of that deal and finish it for 58 cents, that would leave us with what? About $2.32 of profit. On the other hand, if we receive a credit, but it costs us $6.45 to close this deal, we'd have about $3.55 of losses. There we go. So let's click confirm and send. This brings up our confirmation screen. We're looking to sell for $2.90 to get into this vertical spread. Hopefully buying out for just 58 cents or buying out for as much as 6.45. That stop is not a guarantee that we're going to close out at exactly 6.45. If the stock is moving rapidly in the wrong direction or gaps downward, we can have a larger loss. But this is just an effort to take profits or take losses. So there are commissions on each side of these trades to get into or out of them. But then we just send that order off and we'd be done. Actually, let's go ahead. Let's send that off. There we go. So guys, that does it. We've actually done everything that I set out to do today. I wanted to take a look at the markets with that interesting context of what's happened at this time of year on the seasonality chart, and then use that to theoretically set up a bullish vertical spread with a plan for managing profits or losses. I think I sense that for some of you, this is going to be a first-time effort. Yep, I expected that. This is going to be something that takes a little bit of repetition. Make sure that you're rewatching the archives if you need some help with that. So if you haven't done it yet, make sure that you have subscribed to our Trader Talks channel. Just go to Trader Talks Schwab Coaching Webcasts. You can go down below the video right now and click on the subscribe button. But this is where you can join the live streams. You can also find our playlists right here. Now, Mike and I would also suggest that you follow us on social media. You can follow us both on X. You can find Mike on X at Mike Fairborn CS. You can find me on X at Cameron May CS. There's my handle right there. But I'm very active here, and if you reply to one of my posts here, I just try to reply right back to you. But you can also follow me on LinkedIn now. So go to linkedin.com/in/Cameron May CS. And if you reply anywhere on social media to my posts, I reply back to you. Best place to connect with me in between these live streams. So everybody, thanks for giving me your time today. Mike, thanks for helping out in chat. Thanks for all the thumbs up. I can see 202 people still watching the live stream right now. And how many? 44. I've already clicked the thumbs up. That's definitely appreciated. I'm going to set you loose, everybody. We'll look for you in tomorrow's webcast. I want you to go enjoy the rest of today's webcast, of course, but I have something new each day of the week. I'll look for you in a future webcast. I'll also look for you on social media. But whenever I see you again, until that moment arrives, I want to wish the very best of luck. Happy trading. Bye-bye.